Quick ask. Subscribe now, then let's jump in with the numbers. Something has shifted in Virginia, and you don't need a report to feel it. You feel it pulling into an open house that should be busy, but the driveway is empty. You feel it scrolling listings with the same photos, the same descriptions, just a quieter number at the bottom. Price reduced appears once. Then again, stacked like a confession sellers don't want to make out loud. Virginia wasn't supposed to feel like this. For years, it was the dependable market, the place where jobs, proximity, and demand insulated prices from doubt. But in 2025, confidence is thinning, not collapsing, not panicking. Something more important. Buyers are pausing, sellers are waiting, and in that pause, leverage is moving without anyone announcing it. This isn't a crash you hear before you see. It shows up in listings that refresh instead of sell, in homes that sit through weekends that used to matter, in price cuts that don't bring offers back. When demand steps back quietly, outcomes usually follow later. So in this video, we're not here to scare you. We're here to get specific. I'm going to walk you through 10 Virginia cities where price cuts are exploding in 2025, not as a headline, but as a signal. Because people who do well in markets like this aren't loud or early. They're observant, patient, and willing to let math replace momentum. 2 cities on this list will surprise even locals, and once you see why, the rest makes uncomfortable sense quickly. Virginia's housing slowdown didn't arrive suddenly. It arrived through math reasserting itself. For years, buyers stretched because low rates made stretching feel harmless. Proximity to Washington, strong salaries, and steady migration softened every decision. But in 2025, that cushion disappeared. Payments jumped faster than incomes, especially in DC-adjacent regions where price expectations were built on yesterday's borrowing costs. What once felt manageable now feels heavy, and weight changes behavior. Affordability ceilings are the first pressure point. When households can technically qualify, but feel squeezed month after month, demand doesn't collapse. It hesitates. That hesitation spreads quietly. Insurance premiums rose. Property taxes stayed firm. Everyday expenses crept higher. Together, they turned high-income areas into pressure zones. Sellers remember peak prices. Buyers live in present payments. That gap creates friction markets cannot ignore. Then there's the post-pandemic hangover. Too many listings were priced for urgency that no longer exists. Sellers anchored to 2021 momentum are now negotiating with 2025 reality. Small price cuts appear, then another. Not strategy, discovery. This is what price cuts exploding actually means. Cuts become frequent, deeper, and still fail to trigger offers. When reductions stop working, leverage has already shifted. Quietly, investor demand has stepped back as well. Flippers face thinner margins. Short-term, rentals lost optimism. Small landlords feel financing pressure and softer rents. None of this shows up as panic, but it removes a layer of demand that once absorbed excess inventory. Without it, listings linger longer than sellers expect. Throughout this video, I'll rely on 4 signals that matter more than opinions. First, price cuts stacking instead of clearing homes. Second, days on market stretching as buyers wait intentionally. Third, inventory rising slowly but consistently. And fourth, concessions becoming normal rather than exceptional. When these signals appear together, the market has already changed. Virginia's exposure makes this shift feel sharper than in many states. High earners still exist, but higher rates compress their choices quickly. When borrowing costs rise, even strong incomes hit limits. That's why price resistance shows up first here. Sellers believe demand should save them. Buyers know numbers decide. That standoff doesn't explode. It stalls, then tilts, quietly rewarding those who slow down and read the math before headlines form and regret replaces patience for buyers watching closely right now today. If you want to learn to spot these shifts early, subscribe. Clarity beats confidence, especially when money's expensive. Before naming cities, it matters how this list is built, because random rankings create noise, not clarity. Virginia is not one housing market. It's a set of micro markets responding to the same pressure in different ways, and once you organize them by zone, the patterns become obvious. The first zone is the Northern Virginia commuter belt. These areas are shaped by DC salaries, long drives, and expectations set during ultra-low rates. When payments rose, demand didn't disappear, it hesitated, and hesitation is enough to slow inflated pricing. Next is the Richmond Metro and its surrounding suburbs. These markets benefited from spillover growth and lifestyle upgrades, but prices move faster than local wages. When affordability tightens here, listings don't crash, they linger. Then there are tidewater and coastal cities. Lifestyle demand, military stability, and second home optimism kept prices firm, but discretionary buyers pull back quickly when financial pressure rises. These markets stall quietly before they slide. Finally, smaller military, industrial, and legacy towns react the fastest. Demand is thinner, so when buyers pause, there's no cushion. Price discovery happens earlier, and mistakes show up faster. That's why this countdown runs from number 10 to number 1. Cities aren't ranked by popularity or reputation, but by signal stacking. One signal is a warning. 2 signals mean pressure. The final 3 show all 4 at once. Repeated price cuts, longer days on market, rising inventory, and concessions that still don't move homes. Quick one. Subscribe now, because number 3 breaks the narrative most people believe. As we move through this list, watch how often the same patterns repeat. That repetition isn't coincidence. It's the market explaining itself to anyone willing to slow down and listen. Careful observers gain leverage early, while rushed decisions quietly hand advantage to someone else waiting patiently nearby today now. We're starting this list where the cracks are still easy to explain away, but hard to ignore if you slow down. These are hesitation markets, not panic zones, places where price cuts appear quietly while confidence thins week by week. At number 10 is Roanoke. On the surface, it still feels balanced. Listings look tidy, neighborhoods feel stable, and nothing screams distress. But spend time scrolling, and you'll notice homes lingering longer than they used to. Reductions arrive cautiously, small enough to feel reasonable. Pricing starts to fail here because momentum faded. Buyers pause, sellers wait, and time becomes the negotiator. The takeaway is simple: patience. When days on market stretch without urgency returning, leverage is already forming. Number 9 is Lynchburg, where affordability narratives begin to wobble. Homes are still framed as good value, yet listings stack quietly. Demand hasn't vanished, but it's selective. Sellers respond by refreshing photos and trimming prices slightly, hoping presentation solves the problem. It doesn't. Pricing fails here because the buyer pool is thinner than sellers expect. The buyer takeaway is caution, watch transaction volume, not asking prices. When sales slow first, sharper drops often follow. At number 8 is Fredericksburg, a commuter market built on proximity and promise. For years, distance from Northern Virginia felt like a discount. In 2025, higher payments erased that advantage. What you notice are homes returning after failed contracts and price cuts that don't spark activity. Sellers offer credits instead of lowering expectations. Pricing fails because affordability math changed. The buyer takeaway is discipline. Let concessions come to you and avoid negotiating against yourself. Number 7 is Suffolk, where growth optimism met reality. Newer developments compete with nearly identical homes nearby, giving buyers options. Listings sit not because they're flawed, but because supply outpaced urgency. Sellers cut carefully, trying to stay ahead of neighbors doing the same. Pricing fails here through competition. The buyer takeaway is awareness. Track inventory growth closely. When supply builds faster than demand absorbs it, pressure compounds. What connects these 4 markets isn't fear, it's fatigue. Sellers grow tired of waiting. Buyers grow tired of stretching. Markets built on that tension don't collapse suddenly. They soften unevenly, quietly teaching patience to anyone paying attention. These early cracks matter because regret is still optional. You can slow down, you can wait for confirmation, or you can chase momentum that already moved on. As we move up the list, these signals stop whispering and start overlapping. For now, recognize this phase for what it is: the warning stage. Hesitation is always the first step before prices actually move. That's why this part of the countdown matters more than it looks. Early cracks offer time, and time is the rarest advantage in housing cycles. When sellers are still testing and buyers are still watching, mistakes are reversible. Decisions aren't forced. You can compare listings calmly, verify reductions, and walk away without pressure. These markets reward observation over action. They reward restraint over urgency. If you learn to sit comfortably in this phase, you stop feeling late and start feeling prepared. The lesson here isn't to predict bottoms, but to respect signals. When hesitation spreads, pricing eventually follows. People who ignore this stage usually feel it later, when choices shrink and regret replaces patience. Stay present here, and you give yourself options before the noise arrives. That awareness creates confidence, not fear, and confidence allows better timing, better negotiation, and cleaner exits when conditions finally clarify for disciplined buyers. It's the difference between reacting emotionally and moving intentionally when numbers, not narratives, are in control for you now. This is the point in the list where hesitation turns into habit. In these markets, price cuts aren't surprising anymore. They're expected. Sellers are still anchored to 2021 memories, while buyers are fully operating in 2025 math, and that disconnect stretches negotiations longer with every passing week. At number 6 is Newport news. What stands out immediately is repetition. Listings adjust, then adjust again, then add incentives. Homes don't disappear after reductions. They linger. Sellers offer credits, flexible terms, anything to protect the number they believe is fair. Buyers, meanwhile, slow the entire process down. Showings spread out, inspections reopen conversations, deals take longer or fall apart. Pricing fails here because urgency vanished. The warning label for Newport news is velocity. Stabilization only begins when homes start moving without layered incentives and constant renegotiation. Number 5 is Richmond, and this is where cognitive dissonance hits hardest. Richmond is a genuinely strong city. Jobs, culture, growth, lifestyle appeal, all of it is real. But strength doesn't cancel affordability math. Prices in certain pockets ran far ahead of what local incomes can comfortably carry. Now buyers are pushing back. You'll see solid homes take multiple cuts, not because something is wrong with them, but because expectations overshot reality. Negotiations drag. Sellers compromise quietly. Buyers wait intentionally. Pricing fails here because alignment broke. The warning label for Richmond is affordability reconnection. Stability requires prices to realign with what residents can actually pay each month without strain. The emotional shift here is subtle but important. Buyers no longer feel late. They feel cautious. Sellers sense it too, even if they won't say it out loud. Follow-up slow. Silence replaces urgency. That silence is information. Subscribe now because the top 3 aren't cooling, they're breaking. At number 4 is Alexandria, where prestige meets pressure. Alexandria carries a premium identity, and premium markets don't break loudly. They slow quietly. What you notice first isn't desperation, but scrutiny. Buyers take longer. They ask more questions. They walk away more often. High prices invite higher standards, and when rates rise, those standards become unforgiving. Listings sit even after reductions, not due to lack of interest, but because buyers have options and time. Sellers resist deep cuts at first, testing smaller reductions that don't clear inventory. Pricing fails here because leverage flipped psychologically. The warning label for Alexandria is urgency. Until buyers feel pressure to act again, leverage stays with patience. What ties these 3 markets together isn't weakness, it's mismatch. Great cities, wrong timing. Sellers are still pricing for speed. Buyers are negotiating for safety. When those 2 mindsets collide, momentum bends instead of breaking. This is where identity starts to shift. Buyers stop thinking of themselves as lucky to be included and start acting like decision makers. Sellers stop assuming demand will save them. That psychological flip matters more than any single statistic. In pressure zones like these, time replaces speed as the advantage. Those who rush inherit risk. Those who wait gain leverage, clarity, and optionality. These markets don't reward bravery right now. They reward restraint. As we move toward the final three, notice how the signals begin to overlap more aggressively. It's no longer just price cuts or longer days on market. It's the combination. Cuts that don't work, inventory that doesn't clear, buyers who wait on purpose. That stack is what turns pressure into breakdown. For now, take this lesson seriously. Great locations don't guarantee great timing. Opportunity lives where math, confidence, and urgency realign. Until that happens, discipline is not missing out. It's positioning yourself ahead of the moment when clarity finally becomes obvious to everyone else. This is where the story tightens, not because markets suddenly become dramatic, but because the signals stop arguing with each other. Earlier on the list, you could explain things away. A slow weekend, a cautious buyer. In the final three, those explanations run out. Price cuts stack on top of long days on market. Inventory builds while demand hesitates. Concessions appear where confidence used to live. This isn't panic, it's clarity, and clarity is uncomfortable. At number 3 is Virginia Beach, a market long supported by lifestyle demand, military stability, and second home optimism. For years, that mix absorbed almost any price. In 2025, it doesn't. Higher-end listings sit longer than sellers expect, even after multiple reductions. Cuts accelerate because discretionary buyers step back first when rates rise. What's structurally broken here isn't appeal, it's urgency. Buyers no longer feel pressure to act quickly. The buyer playbook is leveraged through patience. Negotiate concessions aggressively, not just price. Watch how inventory behaves through peak seasons. If homes linger when demand should be strongest, the stall isn't temporary, it's structural. Number 2 is Arlington, and this is where reputation collides with reality. Arlington still carries prestige, but prestige doesn't override payment shock. High salaries meet high rates, and suddenly even well-qualified buyers hesitate. Listings sit despite being polished and well-located. Sellers cut cautiously at first, then more often. What's broken here is velocity. Buyers scrutinize every detail and walk away more easily. The playbook in Arlington is discipline. Compare active listings to actual closings, not asking prices. Demand confirmation that reductions slow, and days on market compress before committing. Until then, time is your leverage. If this kind of market intelligence saves you money, subscribe, because number 1 changes how people see Northern Virginia entirely. At number 1 is Loudoun County and the broader Northern Virginia suburb cluster, where every pressure we've discussed converges. These markets thrived on a simple promise: space, safety, and predictability within commuting distance. For a while, that promise justified rising prices. In 2025, the math fails. Payments stretch beyond comfort. Inventory builds quietly. Sellers chase comps downward month by month. Homes compete with nearly identical homes nearby, and buyers feel no urgency at all. What you notice first is sameness. Multiple listings on the same street. Reductions that don't clear inventory. Concessions becoming standard language. What's structurally broken here is the assumption of steady demand. Suburbs rely on predictability. When that steadiness breaks, prices don't drift. They correct. The buyer playbook here is restraint. Do not negotiate against yourself. Push for credits, rate buydowns, inspection leverage. Verify how many comparable homes remain unsold. The confirmation you need before buying is simple but powerful. Inventory must start clearing without incentives. Until then, patience isn't passive. It's strategic. What ties these 3 markets together is alignment. Cuts, time, inventory, and incentives all point in the same direction at once. That alignment flips leverage psychologically before it flips statistically. Buyers stop fearing they'll miss out. Sellers stop assuming demand will save them. The market becomes honest. Crashes don't announce themselves. They reveal themselves to people willing to look without hope or fear. This list isn't about avoiding Virginia. It's about timing. The regret isn't in waiting too long. It's in buying too early, trusting stories instead of signals. When you learn to recognize confirmation instead of chasing certainty, you don't just avoid mistakes. You gain control, clarity, and confidence while others are still negotiating with yesterday's expectations. When you step back from individual cities and look at Virginia as a whole, a calmer pattern emerges. Overpricing didn't collapse these markets by itself. Payment shock finished the job. Homes were listed as if money were still cheap, while buyers were budgeting as if money were expensive. Because it is. That gap is where momentum began to leak. Across all 10 cities, inventory didn't explode overnight. It crept. One extra listing on a street, then another, then another. Sellers blamed seasonality. Buyers told themselves they'd check back later. But markets don't need drama to change direction. They only need hesitation to slow velocity, and once velocity slows, urgency fades. Price cuts follow the same quiet rhythm. Not one dramatic drop, but repeated reductions that slowly normalize negotiation. When cuts stop working, psychology flips. Buyers stop asking what they might miss and start asking what might get cheaper. That single question rewires behavior faster than any headline. Days on market tell the same story. Healthy markets clear quickly even when prices wobble. These didn't. Listings lingered. Time stretched. And when time stretches, leverage moves. Here's a checklist you can apply anywhere in Virginia. Track days on market over time, not just list prices. Watch how often listings cut and whether those cuts actually lead to sales. Notice when concessions become standard instead of rare. Compare rent to mortgage payments because when renting is far cheaper, patience grows. Pay attention to new construction incentives because builders cutting first pressure resale values fast. This checklist isn't meant to scare you. It's meant to steady you. When you learn to read markets this way, you stop reacting emotionally and start choosing deliberately. You stop chasing stories and start verifying signals. Subscribe if you want this checklist applied to your city next. When awareness replaces urgency, confidence follows, and confidence allows better timing, cleaner negotiations, and fewer regrets in markets that shift quietly long before certainty feels comfortable again. That discipline turns uncertainty into advantage for buyers willing to wait, watch, and act only when numbers confirm momentum has truly changed for them now. When markets shift, the mistake is assuming everyone should make the same move. Virginia in 2025 rewards strategy, not speed, and what you do next depends on who you are and what you're trying to protect. If you're a first-time buyer, your edge is patience. This is not the moment to chase listings or waive safeguards. Let sellers come to you. Ask for concessions before price. Watch for confirmation signals. Days on market stretching, repeated cuts that don't spark offers, incentives becoming normal instead of rare. When those stack, urgency has already left the room. Waiting here isn't weakness. It's how you avoid locking in regret at the wrong point of the cycle. If you're a move-up buyer, risk control matters more than lifestyle upgrades. The cleanest play is often sell first, then buy with clarity. Buying before selling ties you to two markets moving in opposite directions. Use contingencies as leverage, not apologies. Price your sale realistically, protect your exit, and negotiate your next purchase from a position of calm. Control beats perfection in markets like this. For investors, 2025 demands realism. Vacancy risk matters more than appreciation stories. Run rent math honestly, not optimistically. If the deal doesn't clear with margin, walk away. Liquidity is your safety net, so think about how easily you could exit if conditions tighten further. Short-term rentals deserve extra caution. Discretionary demand pulls back fast when budgets compress. The common thread across all three paths is restraint. Patience isn't passive anymore. It's power. It allows you to say no without panic and yes without pressure. It shifts your identity from hopeful participant to deliberate decision maker. Virginia isn't offering guarantees this year. It's offering information, and people who listen closely gain flexibility while others freeze. That mindset keeps you solvent, calm, and ready to act when opportunity finally aligns with numbers instead of narratives that mislead emotional buyers daily. In the next video, we'll break down DC suburbs versus military towns, and then dig into specific Virginia cities buyers should avoid next. Subscribe and comment your Virginia city below. I'll cover the most requested one.